All right, guys, this video I'm extremely excited about. There is a ton of value here, and I'm going to pack it all into this little video. But this has saved me and many of my clients thousands and thousands and thousands of dollars. Okay, so we're going to talk about employment tax. Now, you're all familiar with it. If you have a job, if you earn income from an employer, you know if you look at your pay stub that there's federal income tax withholding. But separate from that, there's withholding for Social Security and Medicare. This is called the employment tax. And the employment tax is 15.3% of income, of employment income. 12.4% of that is made up of Social Security, and that is only taxed on up to $147,000 of income. After that point, they no longer withhold additional money to pay into the Social Security system. And then for Medicare, it's 2.9% for Medicare of all wages. And as we discussed in prior videos, there could be a surtax charged on there that could take it up to 3.8%. But that's generally how it is right here. Now, when you work for a company and you're an employee, half of this, so 7.65% is paid by the employer, 7.65% is paid by you. Okay, it's split in half. So they pay half, you pay half. For them, it's tax deductible. It's just a cost of having employees, but it's deductible. For you, it just comes out of your paycheck, withheld automatically. Now, this is not factored in to the whole federal income tax calculation that we've talked about. This is not federal income tax. This is not subject to the withholding, and standard itemized deductions, all of that. This just happens to everybody, period. Okay, so everybody pays it, and that's that. Now, we've heard if you are self-employed, how does this work? When you're self-employed, we hear it called the self-employment tax, because all of a sudden you have to pay 15.3% of it. You're paying the employer side and the employee side, right? You're paying both. So when you are filing as a sole proprietor, right? Let's say you're an independent contractor, you earn 1099 income, that's self-employment income. If you have a side gig, if you started a business, anything like that, that money is considered self-employment income, and you have to pay this employment tax on it. Self-employment tax, 15.3%. It applies to net profit. Okay, so you have your total revenue minus whatever expenses that you deduct out. It is applied to that amount, okay, net profit amount. So let me give you an example. Let's say you have $100,000 of net self-employment income. So that's after all expenses, right? Your profit is $100,000. Well, you owe $15,300 in self-employment tax. And separate from that, you also is calculated like your federal income tax. Like you still have to pay federal income tax on all this money as well, but you're paying $15,300 in self-employment tax, okay? So that's a pretty big deal. So if you're just filing in your own name, or even if you set up an LLC for your business, but you're still filing as a sole proprietor, this is what you are subject to. So how do we get around the self-employment tax? It is a huge, huge burden, especially if you're self-employed. It's hard enough, but then you tack on this tax. So let's talk about how to minimize this. Now, I want to emphasize that you should work with a tax professional. I don't know if I can repeat myself often enough. Work with somebody that is qualified to do this for you. But I am teaching you how this works so you can plan for it and know when you need the help of a professional. So what you can do is you can minimize self-employment tax by electing to file taxes as an S corporation. Okay, this is a special tax status. It is not an entity, right? Like we know a C corp, as we've discussed, is an actual entity. Okay, it's a legal entity. An S corp is not a legal entity. It is just a tax filing status. Essentially, what it is, so you would set up your LLC and then you would elect to file as an S corp. Now, there are requirements of when you can file. There are deadlines and timelines that you have to abide by. That's why you got to work with a professional. But essentially with an S corp, you become the employee and the employer at the same time. So you set a wage and the employee earns the wages and pays employment tax on those wages. On the rest of the profit, it is sent out as a shareholder distribution and is not subject to self-employment tax. It's subject to normal federal income tax, but not self-employment tax. So essentially, what you do is you take the total net profit, you carve out an amount that's set for wages, self-employment tax is charged on that amount, not on the rest. Now, there are a lot of restrictions. Obviously, you can imagine a lot of people try and take advantage of this and say, oh, yeah, my business earned $1 million, but I only earned $10,000 in wages. That's probably not going to fly. The IRS says it must be reasonable. So they don't give a specified amount or way to calculate it. It just says it must be reasonable given your position and what you're doing for the business. So you've got to work with a tax professional that's going to sign off on that, okay? That is really important because you don't want to get audited on that type of thing if you are trying to really just dodge taxes. So let's talk through an example of this, okay? Let's go back to the example of you have $100,000 net profit from the business. Well, let's say you set wages at $25,000. Now, 25% of net income is, by many standards, is a reasonable wage. Theoretically, when you're starting a business, you might be paying yourself a lot less and reinvesting money back into the business. And then maybe after a while, right, you can increase your wages because you're more stable and all that stuff. But especially with startups or small businesses, a lot of times, a lot of that money, a lot of the profits being reinvested into the business. And so you want to set wages low. This is a cost that you have to commit to, right? Just like any other business would have to commit to it, okay? So 25%, it could work. But again, you have to work with a tax professional on this, get their sign off and make sure that you're doing it the right way. But for this example, let's use 25%. So you would set wages, W-2 wages at $25,000. Now, I have an S Corp. Okay, so let's say this is me. As the employee me, I am paying out of my $25,000 of wages, 7.65% in employment tax or payroll tax. That is being sent to the government to pay Social Security and Medicare. As the employer me would pay 7.65% of $25,000. That's deductible for the employer, and I would send that for Social Security and Medicare for the employee, okay? So when you add it up together, again, it's 15.3%. The total then, 15.3% times $25,000 in wages equals $3,825 in employment tax. Then you look at the rest of the net profit. It's $75,000. That is taken out of the business as a shareholder withdrawal or a shareholder distribution. It's not wages. It's not employment income. It's a shareholder distribution. Therefore, it's not subject to employment tax. So on the $75,000 of shareholder distribution, zero employment tax is paid. You pay regular income tax on it, but zero employment tax is paid on that amount. So if we look at this, in this scenario, you were paying on $100,000 in net income, you're paying $3,825 in employment tax. In the scenario, if we look above and you're a sole proprietor and you're paying 15.3% on all of it, that's $15,300. By electing to file as an S Corp and structuring it this way as a tax status, you saved $11,475 in total employment tax. That is a lot, right? That is a massive amount of money. That's compared to how much income you just earned. $11,000 is going to stretch you a long way. Okay. So this can be extremely beneficial. Again, it's important to work with a tax professional that can help you elect to file as an S Corp, can make sure that they're taking account and that you are paying on at least a quarterly basis your self-employment wage taxes from out of your business. Okay. Just like for federal income tax, you would pay quarterly estimated taxes on your income. You got to do the same. You got to withhold and send money for employment taxes. Okay. So you want to work with somebody that can just handle all of that for you and make sure it's done in a compliant way. Okay. But it can be a way to structure this and save you a ton of money. Now, just a word of caution. You want to be reasonable with the wages. Okay. Again, this is a way for a lot of people to try and avoid paying taxes, and it can blow up in your face if you're audited. And the IRS says, wow, no, that's not reasonable at all to pay yourself $25,000 while earning $500,000 of net profit, that is not a reasonable wage, and they're going to come back at you. So you got to be careful. It has to be reasonable. You don't want to get on the bad side of the IRS. The other thing to take in mind here is if you are only self-employed, let's say you're self-employed for the majority of your career. As we talked about the Social Security calculation, what they do is they add up and they take the top years, they average out the top years of your earnings that pay into for Social Security purposes. And that's how your benefit is calculated. So where you were an employee, maybe you're earning $100,000. Well, $100,000 are your Social Security wages that are paid in. So you're paying into that system based on that amount. And so your benefit is going to be higher, right? Based on what you were earning, right? $100,000 or whatever it was. When you do this, in this situation down here, when you say my wages are $25,000, that is the wage that is calculated for Social Security to calculate your Social Security benefit. So when they look back and they take the average of your highest earning years to calculate your benefit, even though your total income was much higher, for Social Security purposes, they're only looking at wages that you paid Social Security tax on, and that's $25,000. So your benefit could be calculated on a much, much lower amount, therefore leaving you with a much smaller Social Security benefit in the future. So that is one thing to keep in mind. When you're just starting, maybe these wages make sense. Maybe after a while, maybe you actually do want to increase the wages so that you're paying more into the Social Security system for your future benefit, right? Maybe as your income grows, you make sure that your wages also grow, right? If your income grows to 200,000 or 300,000 or 400,000 and you do a reasonable wage from that, maybe your wages are $100,000 and you're paying more in employment tax, but you are getting a benefit on the back end, which is a higher Social Security benefit. Okay, so that's one word of caution to just think through, but wonderful strategy for if you have self-employment income, and definitely something you want to work with a tax professional on. All right, there's a ton of value, ton of tax savings there, guys. You can do this, by the way, at any level. There might be a break even because there's some additional cost to filing as an S corp and making sure that you're withholding appropriate amounts for employment tax and things like that. So there's some nominal increase in costs there. But, let's say you earn $20,000 in self-employment income. It may be worth it to elect to file as an S corp because your tax savings is going to outweigh the cost of doing so. And so even if you just have a side gig and you're bringing in 20K a year or 25 or something like that, this can be massive tax savings for you. So definitely something to look into. Awesome. I'm excited about that one. I love that one. Good strategy. Work with a tax professional. We'll see you guys in the next video.
Clarity turns income into wealth.